Hi, everyone. My name is Rob Anton. I'm the president and one of the partners at Next Edge Capital. With me today is Mark Carpani, senior vice president and partner at Ridgewood Capital, and Eddie Wong, who's the vice president of fixed income at Ridgewood Capital. The focus of today was to provide a little update or, an update on the investment grade bond portfolio, outlook for yields, rates, as well as we'll go through a few examples within the portfolio. And I'm going to begin with just a few slides explaining the structure of the portfolio and, the initial purpose of why we came out with this product about a year and a half ago. If you have any questions, you can type them into the Q&A function, and we'll be answering all those at the end of the session. We're expecting this to be somewhere in around 20 minutes, so we won't be too long. When we launched this 2028 investment grade bond trust in December of 2023, the focus was to take advantage of something that we don't really see that often in bond land, and that was the fact that high quality, shorter duration type bonds. We're trading at significant discounts to par value. There's a lot of tax efficiencies that can be seen from, buying bonds at a discount, in the sense that bonds that are trading at a discount to par, them moving to par is taxed as capital gains, whereas the coupon that you receive, the interest payment you receive from a bond, is taxed as income. So the focus of this trust was to, create a portfolio of bonds maturing, whereby the trust matures in March 2028, try to match the portfolio fairly close to the maturity of this portfolio of the trust in March 2028, and focus on creating a portfolio of bonds that are trading at significant discounts to par value. So that has been done. The investment restrictions of the portfolio: minimum 75% of the portfolio has to be investment grade paper. They can buy some high yield securities. Currently, the portfolio represents about 84% in investment grade paper. As well, in addition to the focus on buying bonds at discounts to maturity, which offers tax benefits, the portfolio is structured whereby we do utilize a little bit of leverage, which improves the tax efficiency of the portfolio as well. And we'll get into that in a few minutes here. As far as some of the key highlights or benefits of the fund, attractive return potential. As of the end of last month, so almost 2 weeks ago, but the portfolio had a yield to maturity of 7.05%. Quite attractive. I was just looking up 3-year GIC rates earlier this morning, and I think the highest I saw was maybe around 3.5%, which most stated 3-year GIC rates, around low threes. So significant pickup, on a lot of other fixed income, products there. So a very attractive yield. There is significant tax benefits to purchasing, this fund in non-registered accounts, in the sense that, a combination of the fact that buying bonds at a discount, whereby the current price as of the end of April was 96.26, and the utilization of a little bit of leverage, whereby we can write off the cost of that leverage and use it to buy more bonds trading at a discount, improves that tax efficiency, whereby currently we estimate, based on the model, around 26% of that yield to maturity will be taxed as capital gains instead of interest income, which is very beneficial. On an interest, pre-tax interest equivalent basis, that increases the yield to maturity from 7.05% to 8.1% for taxable accounts. So significant benefits. Each year, we set a distribution rate for the portfolio. For 2025, that distribution rate will be 14 cents a quarter. Based on the current NAV, that works out to be about 5.4% that we're paying out in distributions each quarter. We've partnered with Ridgewood Capital on this product. They have a lot of experience in managing bond portfolios. I'll let Mark and Eddie talk about a little bit about Ridgewood and their history and what they're doing with this portfolio. But over the past decade and a half have significantly outperformed peer benchmarks, on not just this portfolio, but in other mandates, in the investment grade bond as well as other mandates that they run. One thing that I will mention is that we feel by matching the term of the underlying portfolio fairly closely in and around the maturity date of March 2028, so just under 3 years, us quoting a yield to maturity and a tax efficiency becomes a little bit more something that we can say with a little bit more confidence than if you had an open-ended fund whereby the maturity date there isn't one, whereby, if our average term of our portfolio right now is just under 3 years, and a year from now, that'll probably turn into 2. Whereas on an open-ended vehicle, that has, a duration of 3 years, in 2 years from now, that could be 3 or 4 years still. So, by matching this portfolio fairly closely to the term of the fund, it definitely achieves the goal of one, attaining, tax efficiency and giving people the type of tax efficiency that they're going to be seeing, as well as, a yield to maturity. A few things on the fund. So the 2028 investment grade bond trust trades on the Toronto Stock Exchange under the symbol IGBT.UN. For those that don't wish to hold the traded unit, you do have the option on a monthly basis to switch it to a non-traded unit, and or back again from a non-traded unit to a traded unit if you don't want to deal with the mark-to-market price from the market. That said, in the last year and a half since this product's been out, the trading price has been quite close to the actual daily NAV of the fund. We talked about the distribution already. Management fee 70 basis points. There is a mandatory purchase program at any time that the fund, the trading price trades at a 3% or greater discount to the net asset value. We've had to very rarely utilize that, so the trading price has been really good. The fund is registered, plan eligible, and matures in just under 3 years. So with that, I'll pass it over to Mark and Eddie. You guys let me know when you want to change slides, but to talk a bit about Ridgewood Capital, and the portfolio. Take it away, guys.
Thanks, Rob. So we were founded in 2008, as you can see, so just over 17 years ago. We started with well under $1 billion in assets, mixed sort of between equities and bonds. We've since grown that to just under $2 billion, the majority of that being in fixed income, and the majority of that being in these types of portfolios that the Next Edge Trust is, which is corporate bonds, short, mid, and long-term corporate bond portfolios of various investment policies. So that is kind of what we've been doing for the entire tenure of Ridgewood. We have a variety of clients: high net worth, endowment, First Nations. The bulk of them are institutions. We've got some awards that we're pretty proud of in all of our funds, which we'll get to. And go ahead, Rob, you can switch. So about the awards, so I guess starting in 2018, because we obviously got to build a record. We've won in most of our funds: the bond fund, tactical yield fund, and the investment grade bond fund. So various mandates. The investment grade bond would be close to the Next Edge investment grade bond trust, being sort of a shorter term corporate fund with a little bit of leverage. And the other two funds, the tactical yield, which is high yield, and our bond fund, there is no leverage on those. They're just your traditional bond funds. Next slide. Okay. So here's the record that Rob and I and Eddie, when we first launched this fund, we went out on the road with this because people maybe didn't know about Ridgewood. just to show that sort of what we could do with short and midterm corporate bonds. And we're using the same strategy with the Next Edge Trust. And, we're pretty proud of our long-term record. And we feel that so far this is representative of the Next Edge Fund. So here is 3 different yield curves. Starting at the bottom with the blue line is the Government of Canada curve, the red being the single A curve, and the green, the triple B curve. So these are all the bonds in the index. And so they're sort of the average, and just plot, as you know, on a yield curve, the yield on the left and term on the bottom. Overlaid that, is the investment grade bond trust. You can see the term and yield Rob mentions just over 7%, which is where we're sort of sitting right now, and a term of just under 3 years. So fairly attractive relative to what you can get in the overall bond market, and certainly compared to cash. So here's the just an overview of the portfolio. On the left, you've got the credit rating buckets broken down from A all the way to double B low. Just over 83% of the portfolio is an investment grade, which gives its risk rating. And you can see that it's just under 3-year term, but the overall average rating is investment grade triple B, and still a decent discount, not as low as at launch, but just over $96 would be the weighted average price. And then our top 10 holdings on the right, and well diversified across a number of industries. And again, this portfolio being mostly passive, the only time we will a bond is removed is when it matures, or if there's a concern. And so far, there's been no changes to the portfolio since inception. Term structure, we obviously try to match as close as we can to the maturity date of March 2028. That's obviously not entirely doable. So it is fairly laddered up to 5 years. Obviously, in 2028, when we wind up the fund, the 4-year and 5-year bonds will be one-year bonds at that point, 1 to 2 year bonds. So we'll sell those. They'll be very liquid and very close to par, so almost like money market. And then the shorter stuff under 2 year, which that will just be rolled into bonds that match the target maturity date, or depending on the market, we will use that to reduce some of the leverage at that time. We talked about the YTM and then the average coupon on the right. So fairly attractive on a pre and after tax basis.
Mark, I'm going to just jump in for a second and go back to the slide. So, a few questions that we get from people is, how you're able to attain, vastly higher yield to maturity. 84% of the portfolio is currently in investment grade, and you really don't go that much below triple Bs on the rest of the portfolio. So, obviously some of it is the utilization of leverage, where we've locked in a, fairly cheap rate and are able to make a bit of a spread, which is additive to the yield to maturity. But can you give people maybe a few points on why the yield is fairly high, or quite a bit higher than what you're seeing on some of those green and red and blue lines here, and maybe a few examples might help with that.
Yeah, for sure, Rob. That's a good point. Thank you. So a lot of the stuff that the Ridgewood team and Eddie and I will focus on is sort of bonds that are not well covered, that have optionality in them. And those bonds tend to be a little harder to trade and source, but that's what we've been focusing on, and that's sort of our specialty. A few examples in the insurance side, Manulife has a hybrid security, sort of falls under the limited recourse capital structure. It's a junior subordinated bond, but it's investment grade. Right now, it has a yield to call of about 17%, trades at about 85 cents in the dollar. And the reason for that is it is callable in 1 year. If it doesn't get called, then it will float at about 300 basis points over 5 years. So even in a worst case scenario, we will have investment grade insurance paper yielding around 6%, but on a yield to call basis, it's trading at 85 cents on the dollar and a 17% yield. Similar with Empire Life, almost identical structure, also trading around a 17% yield to call. And if they don't call it, we're still going to get about a 6% bond with a 5-year term. So these bonds are less liquid and again, difficult to source and trade, but we have exposure to these in the investment grade bond trust and pretty much all of our mandates.
Great, thanks.
No problem.
And I guess one follow-up question to that is, thoughts on where we are in the bond market. Do you are we staying steady? Are interest rates going to decrease, increase, or where? And with that, where do you find opportunity? You gave a good example there, but maybe you can follow up with those answers.
Yeah, no, that's an excellent question. That sort of lends to our strategy and this strategy, in that our preferred area of the bond market is, well, not just credit, but short credit, and in some cases midterm credit. Well, why is that? Even if rates don't drop and they go sideways, we're carrying a tremendous yield over and above the passive benchmark and or government bonds and more liquid type securities. We do think there's going to be cuts in Canada over the next 6 to 12 months, probably up to 50 basis points. So that would add further to the capital appreciation and also the fixed income component of the portfolio. But again, we're indifferent with this strategy and a lot of our other strategies because a lot of our bonds are in the short end. And again, they're going to pull to par regardless of what happens.
Yeah. So do you think the current opportunity with the yield to maturity in the portfolio is fairly opportunistic right now for people that wish to come in relative to, we obviously don't have crystal balls, but relative to 3 to 6 months from now, you think they'll start coming back down in the 6.5% yield to maturity range?
Yeah, I do think, rates, if anything, will be sideways at worst and likely down. And again, you look at the steepness of the yield curves, these shorter term corporate bonds, the spreads will tighten as we get closer to par. And I don't think we're going to see much higher rates for the life of this product. Growth is slowing, inflation is slowing. There's some tariff things that are starting to resolve themselves, but net there still is tariffs, and that's a drag on growth and a tax on the consumer. So flat to lower rates, I think, for an extended period of time.
Perfect. I'm gonna just summarize a couple of points here, and then if you have any questions, just please type them into the Q&A function and we'll answer them. So on the 2028 investment grade bond trust, IGBT.UN, this was launched in late December of 2023. And, since then has, achieved the targets that we were looking for. It's annualized at about just under 9.5% in the last year and 4 months versus, the iShare Canadian short-term bond index, which has done about 7.5. So significant outperformance in a very short period of time, similar to what they've done, historically. Summarizing, some of what we've discussed, in this meeting so far, why would you consider, the investment grade bond trust? We think there's a few reasons, attractive yield to maturity. Currently that yield as of the end of last month was 7.05%. When you include the tax, efficiency that we discussed, that goes up to 8.1%. Or, on the pre-tax interest equivalent return for a person in the highest tax bracket. Distributions will be paid out quarterly, currently based on the, current NAV that works out to be about a 5.4% payout for 2025. Tax efficiency, what I just mentioned as far as a pre-tax interest equivalent yield works out to be about a 26% of the yield to maturity is expected to be capital gains. Due to the, average price still trading at a discount to par value, as well as some of the way that we structured the portfolio. This is short-term paper. The portfolio will go to cash, in March 2028. So just under 3 years. So very, very, very attractive relative to other fixed income components. Ridgewood's a top quality manager and has, proven over, vastly more than a decade of, having top quality, bond portfolios and showing, outperformance. And, this structure allows for, clarity as far as yield to maturity and tax, efficiency by having a fairly, quasi-static portfolio matched to the term of the product, which you will not achieve in similar open-ended vehicles from a tax standpoint. So with that, I'll open it up for questions. If you have any questions, just type them in your Q&A function and we'll answer a few of them. Maybe I'll just start things off, Mark, although I've asked you a few already, but we when we first launched this trust, in December of 2023, we kind of picked a fairly opportune time to launch it. Maybe we were off of the peak by a month or two, but it's a fairly good timing on that. Since then, yields have kind of come down to some degree, and then recently over the past maybe two and a half months, with a lot of the noise that's going on in the market, you saw yields come back up. It is in general, or is some of that due to obviously the market volatility, and two, did you see actually some of that volatility create more opportunity in some of these names, such as the Manulife name? Did they sell off a little bit more and create a more opportunistic type buying opportunity right now? Maybe give your thoughts on that.
Yeah, that's a good point. When we started the trust, a lot of the limited recourse capital notes and AT1 and hybrid securities were trading in the high 70s, mid to high 70s, and that's where we established the portfolio and bought a lot of these types of bonds. Last year they had a very good move, and they got up into the low 90s, and which provided a lot of the alpha for the portfolio. And to your point, the last month or so, or at least up until this week, they've come back a little bit. But the last month or so, they've fallen off with the equity market, with the risk off move and the decline in equities, and they got down into the sort of the low 80s again. And now they're kind of mid 80s now, mid to high 80s. So we did use that opportunity then to add in some of our other mandates. But you're right, it provides a window now for investors to basically sort of get in at those levels, these mid 80s, and most of these structures, which likely will pull to par over the next 1, 2, 3 years. And in some of the other pipeline hybrid securities that we have, Kiera and IPL and Bridge, etc., TRAP, they've also come back a little bit, and they're still now recovering with the risk back on environment since the news with China. So things look pretty good, and it looks like it's going to be another fairly strong year for fixed income.
Perfect. One thing I should mention that I forgot to, this trust does trade on the Toronto Stock Exchange under the symbol IGBT.UN. And in addition to, obviously, you can going into the market and piecing your buys in, we did create an ATM, on the product, whereby we can guarantee you fills at the previous day's net asset value, which gets posted to our website each evening, plus 2 cents. So if you do come in with size and find you can't get your fill on any given day, just reach out to us and we can coordinate that you're getting filled. But typically a market maker would be there at NAV plus 2 cents, and you can kind of get all the fills that you want. Any large order, just reach out to us first. Here's another question, Mark. It doesn't make that much sense to me, but it's probably make more sense to you. But any idea on what happened in terms of trading in late December?
Any specific, like just in general for credit?
Yeah, that's all the question says.
Well, I guess the main thing on the credit side, which is I guess our focus and the focus of this, is there was a pretty good rally in risk, and particularly the higher beta type of bond structures that we have, the hybrid securities and the bonds with optionality. I think investors were realizing that there's going to be further cuts by the central bank, particularly the Bank of Canada. And there was sort of this grab for yield, whether it was ETFs, funds, actual corporate bonds, or structures like the Next Edge investment grade bond trust. And the bonds that we had within the portfolio, we had the majority of a return literally in the last sort of 6-7 weeks of the year. So I think it was just more that realization that these bonds were very, very cheap and mispriced. And that tends to happen. And then all of a sudden, there's a grab for yield and investors rush in, and we get these fairly dramatic moves in the market.
Perfect. Thank you. So there's no further questions in the queue. Mark and Eddie, thanks for joining and providing some input here. And thanks to everyone that joined us today. If you have any questions, either give me or your regional Next Edge representative a shout. And curious about hearing your feedback. We think a pretty, great opportunity presenting itself here, and look forward to your feedback. Or if you have any questions, we're there to answer them. Thanks. Have a great day.
Thank you.